Very good morning and welcome. You're watching India Market Open, and it looks like a great day for the markets after the Fed surprise. But Agam, before we start, I just wanted to, take a second to think about all the lives lost in that horrid fire in Kuwait. 41 Indians at least and counting. It's something that the government is taking very, very seriously. Efforts are being made, for those who are injured. But of course, over 40 Indians have been killed. So our heart goes out to those families. So that's one piece of sad news. But from the market's perspective, I think all this morning is going to be about soaking in the Fed and Powell's message, which is that at least we're making progress towards the inflation target.
Sure.
Yeah.
I'm actually reading a handful of comments from economists abroad, and they all seem to be very happy that this is an important battle. It's not the war. The war is not being won yet, but it's an important battle, and perhaps a low inflation number certainly plays in favor of the economy in the long run as far as the US is concerned.
So I would say a double delight in that sense. The CPI number for the last month was good, much better than what was expected, 0.1% lower than what was expected on both ends for the month and the year. So that's been great. Plus, of course, you had Fed speak. So let me just take you through the global cues. I'm calling them mixed simply because you had, the Dow, which closed flat to negative, slightly lower, and slightly in the red. The Dow futures are also slightly lower, but it's the S&P 500, which was the star in a sense, closed above the 5,400 mark for the first time, record high. NASDAQ at a record high close as well, nearly 1.5% up, and that's because of Fed speak, mostly speaking. And let's just pull up for you just bits of what the Fed did, and we'll give you more details. We'll play out what Jerome Powell said. We have a great conversation coming up as well. But the outlook has been positive. The key words here is that the Fed sees modest further progress towards this 2% goal. As expected for the 7th consecutive time, the Fed did keep interest rates unchanged, but that was sort of clued in or accounted for. I think the big change has been that the dot plot, which is to put it simply an amalgamation of views from all Federal Reserve officials, now pencils in one rate cut for calendar year 2024, maybe up to 100 basis points in the next calendar year. So at least that one rate cut is still there. So that's actually lesser than the last time we had this dot plot from the Fed officials. But nevertheless, that has been seen as a big positive. Like I mentioned, inflation numbers have been good. As a result, look at what's happened to the 10-year. And that's actually been quite interesting because the 10-year at 4.3% is benign from an Indian point of view. At one point, it went down as much as 4.25% on both those factors, positive inflation numbers and the Fed commentary, which really, really helped. Crude prices have, been giving us good news as well. They've slipped again, and Brent is a little above $82 a barrel. The expectation that you won't have too much demand is the reason for it. But again, from an Indian perspective, not bad at all. I want to pull up Asia and see how Asia is, waking up, largely positive in the green, as you can see. And if you see the implied open, as far as India is concerned, then, some of that sort of green should rub off. We're expecting nearly 100-point open on the Nifty as per the implied open. I'm just going to quickly pull up the fund flows yesterday. And yesterday, I think, was a bit of a tepid day, Agam. Nothing much happening. And has been, you can see that in the fund flows. Right. Minuscule, a trickle over there in terms of action. I think a breather after all of the news flow has come in over the last 10 odd days.
Right. Well, we have good news from India here as well, from the economic perspective. And of course, the CPI in this case has come in at around 4.75. This is the lowest in the last 12 months and also lower than the April number, naturally, which stood at around 4.83. And that is also something that markets will consider and factor in as far as their open is concerned today. Now, that said, this is largely led by a reduction in fuel costs and food prices, which have been sticky. The food inflation specifically has been very, very sticky over the last few months, and that seems to have been coming off as well. and this is in the months of summer. So that's a positive. Of course, moving on, we are also considering how things could potentially pan out for our own market. So Tamanna did mention that we are looking at a buy number. It may have been a small buy number, but both DIIs and FIIs have bought into Indian markets. And in fact, over the last 4 sessions, FIIs have turned net buyers. So if you actually consider the fund flows, while DIIs continue to buy, FIIs have now started to come in. Of course, a lot of that will have to do with the continuity in our political regime. That's it. Yeah.
Just talking about the FI numbers, and that's really interesting. And you're right, directionally, Agam, they've turned positive, but the quantum or the volumes are still very, very hesitant.
Yeah.
This is not the flood. This is the trickle before the flood, if the flood's coming.
If the floods come in, and when they do, they will. And I reckon that maybe at least FIs are waiting to hear more from the government. We'll have the upcoming union budget back later in July. Of course, the earnings season will also potentially set a certain trend. And but now that we have clarity on that big event, I reckon that's out of the way. At least in today's day of trade, we're looking at the Nifty weekly options expiry. We're looking at a 500-point range, 23,000 on the lower end, 23,500 on the higher end. These are your respective supports and resistances that we could keep an eye on in today's day of trade. Of course, the Bank Nifty is a very curious one because yesterday it went above the mark of 50,000 with a lot of gusto and eventually closed below 50,000. So that of course is going to be how things are, especially when you don't have as much liquidity. And yesterday was a very quiet market. You did not have a lot in terms of turnovers too. And finally, I want to address what's really happening, in the broader markets as well. Now, I was just taking stock of year-to-date returns for the Nifty, the CNX 500, the NSE 150, and the small cap 250. And while the Nifty 50 has advanced by around 4.5% on a financial year-to-date basis, look at the staggering outperformance for the NSE Mid-Cap 150 and the NSE Small Cap 250. 14.5% and a 15.5% gains for each of them. For many of these investors, well, your year is done. You just book profits and with those kind of returns, and then you go home and not do anything at all for the remaining 9 months, and you'll still be okay. That said, the other point that does come to fore is the valuations, which also are becoming more and more for the day in, day out when it comes to the broader markets. And that's something that a lot of our analysts and experts have also been pointing out. So that's something to be wary about going into trade over the next few weeks, Tamanna.
Yeah, I found that interesting. You have to give. I think you've got a lot of people excited with the idea of booking profits and enjoying the rest of the year as a holiday. Yes. But then that depends on how much you spend through the year. But yes, let's get to stock-specific action. And before we get to a few that we've picked today, I just want to talk about 2 groups of stocks that might see action. One, of course, is IT companies that saw a bit of a boost earlier in the week. And remember, that was because of the ECB's rate cut. Now, the Fed has not quite cut rates. That was not even expected. But the fact that directionally you have seen, I would say, a not hawkish view, and that saw the Nasdaq going up as well, could see a positive impact for IT companies. So keep an eye on the IT index, the Nifty IT index, as well as their components at the start of trade. That's one. And the other one is what the regulator has done on surrender values. Agam, I thought that was fairly important, and we'll get a more detailed report from Harsh ahead in the show. But this is important. Essentially, in the protection and towards the protection of policy holders, IRDAI, that's the regulator for insurance companies, has increased the surrender value of policies. Essentially, that means if you have a policy, a life insurance policy, and you want to surrender it, you want to stop that policy, then the amount you get back will improve as a policy holder. Now, what does it mean for companies is the question. Nuvama is out with a note. MK has a view. Essentially, companies that are larger, have a larger base, are going to be better off because to stick to these new guidelines, you are going to have to reduce commission and look at your margins very, very carefully. In fact, MK has maintained a buy on HDFC Life, so specific stocks you can put on your radar. They see an upside of 27%, ICICI Pru an upside of 21%, SBI Life an upside of 24%. They've maintained an ad on LIC, see a target price of 1,200 rupees, and Max Life, they see a target price of 1150. In fact, SBI Life seems to be the hot favorite from a couple of houses this morning. So keep an eye on SBI Life. Now, in terms of specific stocks, I'll just take one or two and then I'll come to Agam. Dr. Reddy's was one, which I found this interesting. They're wholly owned subsidiaries in a licensing pact with a US-based company called Ingenus Pharmaceuticals. This arm will get exclusive rights to commercialize an injection in the United States. It's called cyclophosphamide, and 50% of the profit share goes to Ingenus. So that's the deal. They've commercialized it from Ingenus. 50% profit goes to it, but it's quite a big market. It's a $51.8 million market in the US. These injections for all sorts of cancers. So that might be seen as a positive for Dr. Reddy's as well. A couple of more, but I'll come back to those, Agam.
Yeah, so I have a bunch as well on my radar, and I'll start off with Soba because we actually have details with respect to its rights issue. Now, the rights issue is going to be carried out at a 20% discount to yesterday's closing price, and the rights issue is going to open on the 28th of June, close on the 4th of July. The company is looking to raise about 2,000 odd crores, the ratio for rights issue stands at around 6 rights equity shares for 47 shares held. Now, they're going to use a bulk of this to repay certain borrowings. They're also going to use some of it for their ongoing projects, also purchasing equipment and machinery. But most of it, about 900 crores of these 2,000 crores, is going to go towards repayment of their debt. The other one on my radar, of course, is also Gensol Engineering. Now, this one is a top bidder when it comes to Gujarat Urja Vikas Nigam's 250 megawatt battery energy storage project. This is a trend which is now starting to pick up for a lot of companies in general. It is, and that is the battery energy storage, units that a lot of companies will be expected to put out. I reckon that Gensol Engineering is one of the first, and this specific project is worth around 1,340 crores, and for the size of Gensol Engineering, this certainly is a relatively larger one to be considered. The project has a green shoe option of reaching 500 megawatts. That's twice the capacity. Plans fall into place, and the revenue potential for the exercise of the green shoe option, or rather including the green shoe option, could be a little less than 2,700 crores. Again, a relatively large number for Gensol Engineering. So these are the other two stocks which also a lot of viewers should keep on their radar today.
So just a couple of more. 361 WAM was one. They've approved the acquisition of Money Goals Solution from Times Internet for about 366 crores. That acquisition will be partly via cash, that's 86 crores, and the rest versus allotment of 35 lakh shares. So they're not too much of a cash payout. This is basically a property called ET Money that they're going to be buying. Citi has a view on this, and they've maintained a buy for the stock 361 WAM with an upside of 16%. Now, what this does is it ventures into retail and affluent focused wealth tech inorganically, because that's what the site is for ET Money. So as an outreach, it works for 361 WAM as per the Citi note. They say that the cash consideration and preferential allotment of 3.59 million shares is 1% dilution only. It will focus on leveraging its wide product suite and broking license. So that is one that you could look at. The other one I thought was interesting was Nestle. The board has approved a continuation of royalty payment at current rate of 4.5% to parent company. The good thing is that that there is no increase in that royalty payment, so margins will be protected. And if you look back to Nestle's last quarterly numbers, they didn't do quite badly. at all, in fact. It was a positive surprise for the street. Also remember that defensive plays and FMCG have been having these spurts of interest in the last couple of days. Yeah. So Nestle is one that I would watch out for.
Yeah, well, rule green shoots, that's the phrase, that's the catchword for FMCG
I'll see it when I believe it.
Absolutely, yes. I'm sure that a lot of investors are not just buying that story just yet.
Yeah.
I reckon that even they were waiting on, the results of that. Perhaps the first quarter will give us a better idea of that. But, let's talk about a handful more, and we have Bondara Engineering as well in focus today because of company receiving a work order worth 940 odd crores from NLC India, and this is for setting up a 600 megawatt grid connected solar power project. That's the other one. The order includes operation and maintenance for 3 years. So again, good visibility for this particular company. And then, of course, we have L&T Finance. Now, Bloomberg reports that shareholders are likely to sell about 8.8 crore shares with the floor price of about 169 rupees per share, which is not too far away from the current market price of L&T Finance. And that's the other one that we will also be watching out for today.
Okay, so L&T Finance is on the radar. In a second from now, we'll be speaking with Peter Cardillo of Spartan Capital and get more in on that. But, in the interim, I think we should just review and go back to what the Federal Reserve has said. We have some clips from Jerome Powell's statements as well. We'll come to that. I thought this was interesting, Agam, because a lot of economists today, and you were talking about how they're seeing this also as a hawkish tone.
Yeah.
And what they're basing that on is the fact that the dot plot has now gone from 2 rate cuts in 2024 to 1.
Right.
So it's a bit of a mixed way of looking at it. The other way people are looking at it is, but at the end of the day, at least the Fed is saying that you are moving progressively towards the 2% growth. And Powell also saying that nobody in that committee this time round had a base case of a rate hike. Right. Which is something they mentioned last time.
Yeah, absolutely. And, from the comments of a lot of economists that I've been going through right now, and as I suggested, I reiterate that the fact that the CPI print has come in at the market has, it's only a battle. It's not necessarily the war, and it's a long-drawn war, and which is something which is going to be taken into consideration when it comes to the Federal Reserve in terms of the interest rate trajectory. And of course, the chairman has already suggested that you could likely have 4 cuts in the next year and potentially 1 this year, but July won't be it. July won't be the month where you will see any cuts, and I reckon that the Federal Reserve will have to wait and watch out for a lot more in terms of economic data coming in from the US. Besides that, we also need to take into consideration the kind of employment numbers that are coming through. And of course, that will also have a repercussion, consumption as well in terms of retail going forward, as well as how services are doing as far as the US is concerned. A lot of considerations to make, but for now, I reckon that the Federal Reserve Chairman has, given us a lot more clarity in terms of the interest rate trajectory. We still have about 5 more months to go in this year, and it's going to be a long year. Let's not forget that we also have the U.S. elections later on in the year, and that's also going to, have some sort of bearing on the economy.
I think it will be. I mean, I find all politics interesting, but the way Joe Biden's son is in trouble, Hunter Biden, I want to see if that makes a difference and boosts Trump. Anyway, talking about Jerome Powell, let's listen into some of the comments that he's made yesterday. Among other things, the Fed chair has said the central bank does not have the confidence yet to cut rates, even as inflation has eased from peak levels.
We see today's report as progress and as building confidence, but we don't see ourselves as having the confidence that would warrant beginning to loosen policy at this time. And we have to deal with that uncertainty around data. The policy is restrictive and is having the effects that we would hope for. We think we're getting the things that we would want to get, broadly speaking. rate cuts that might have taken place this year, take place next year. We'll just have to see what the incoming data flow brings and how that affects the outlook and the balance of risks. Really, the whole rate path matters, and I do continue to think that when we do start to loosen policy, that will show up in a significant loosening in financial market conditions.
All right, so that was Jerome Powell, talking about the path ahead. Another thing that I'm finding interesting, Agam, is that, remember, in the last, I would say, 6 to 7 months, this Fed sword has been hanging over the head of emerging markets like India, so to speak. Yeah. It's not made too much of a difference to where the markets have run up.
No, it hasn't. And that's certainly, to a certain extent, because of the kind of earnings that the U.S. corporate is coming out with, especially when it comes to some of the elite companies out there. Something like an NVIDIA, something like an Apple, or for that matter, Alphabet. They're all coming up with the goods, and that continues to drive the NASDAQ higher. Even in terms of, moving beyond just tech, you have a reasonably stable earnings scenario, even though there have been, warning shots every now and then talking to us about how things could perhaps get, worse down the line. Well, somehow or the other, a lot of these companies, even beyond technology, are, dishing out relatively stable earnings, and that perhaps has played in favor of the benchmark indices and the way they're going. In NASDAQ 100 is trading near a life high, as is the case for Dow Jones. So for now, of course, at least as far as the U.S. equity market is concerned, not as much concern. But sure, and I reckon that to a certain extent, these markets are still factoring in, even if it is the case of just one price, cut, a rate hike, a rate cut at the moment. They're still factoring in perhaps a year down the line. And when I say a year down the line, even if you do see, 1 or 2 more cuts in calendar year 25, the first 3 months, it'll still be a part of this particular ongoing financial year. And that perhaps has some amount of, impact with respect to earnings forecasts as far as FY25 is concerned. And potentially something that is playing in favor of the U.S. equity markets.
Another interesting sort of take or point of view as far as we are concerned is the fact that this time Governor Das said very clearly and indicated very clearly that we don't perhaps have to wait for the Fed to move first.
Yes.
So if we're looking at a September sort of cut from the Fed, will we have one around the same time from the RBI?
Yeah.
And, where does it move? These are all going to be very interesting factors to look out for that we will speak with Peter Cardillo also just in a bit as and when they get him up. Meanwhile, going back to where we're headed for the Indian markets this morning, still a 96-point up on the Nifty. The implied open is showing that we're off to a positive start, and those first rates will be very crucial to watch. Now, I reckon the action also, Agam, shifts to business updates. Those will be coming very quickly. Remember, you had an extended long result season because it was Q4, and you're going to have Q1 business updates coming in. You're going to have corporate results taking the bulk of the attention before we come back to budget.
Absolutely. And, speaking of that, Tamanna, to a certain extent, we have a handful of stocks out there which are factoring in strength. Based on that, we could take a quick detour on talk about 2 other stocks which are on the radar today, and they were buzzing on volumes yesterday. One was, of course, Gravita India, and the other one is Elecon Engineering, and both are very much associated with how the economy is going on, and they've done well yesterday. But I think we should go back and get an expert opinion on how things have fared as far as the U.S. markets are concerned yesterday. Well, we have Peter Cardillo, Chief Market Economist at Spartan Capital Securities, who's joining us on the show. Peter, good evening to you, and thanks so much for taking the time out. First, let's start with the inflation print that we've seen in the U.S. We're looking at mixed cues, at least here in India. While some economists in the U.S. suggest that the battle against, or rather the war against inflation is completely won, there are some others who are a little bit more skeptical with respect to the inflation number. And even though this inflation number looks very, very good, there could be perhaps a few more challenges. What is your reading as far as inflation is concerned at the moment?
I think inflation is headed in the right direction. We had the CPI numbers yesterday, and they were very confronting in the sense that, we saw the core rate actually come in a little bit better than expected. And I think, this is perhaps the first sign that inflation is headed again in the right direction. Of course, we had it, over the past 4 months, inflation heated up. But I think this time it's going to stick. And one of the reasons that I think that inflation is going to head lower is the fact that energy prices have not really moved that very much. They've been basically locked within a trading range. So energy is a lot that adds to the inflation at the consumer's level. Of course, salaries have gone up, but again, if you look at the wage growth over the past 2 months, they seem to be stable, and they're not moving much higher than the average that we've seen. So I kind of think that yesterday's Consumers Price Index is indicating that we're going to see lower inflation during the summer months.
Hi, Peter. Good morning. From where we are, Tamanna here, and great to speak with you as well. I wanted to get your take on what you thought of Jerome Powell's tone and what the Fed is communicating yesterday. Some are seeing it as hawkish. Is it really hawkish, considering that they're now seeing at least a clear movement towards the 2% inflation goal?
Yeah, look, it's going to take time to get down to 2%. I don't expect that, and I don't think the market expects that, and neither does the Fed expect that. But once again, that the Fed took a cautious attitude, and basically, if you sum it all up, what they said is we're going to view this on a meeting-to-meeting basis, which means data dependent. Yes, they continue to keep a cautious and I would say somewhat hawkish rhetoric, but by the same time, I think they're ready to pull the trigger. In fact, during the press conference, Powell did say, if things go our way, we won't hesitate to cut rates. If inflation should heat up again, we will obviously not cut, and if necessary, we will raise rates. So it's a question of looking at the future data, not only inflation, but of course, the labor market as well. And so, I think even though the dot plan indicated just one rate cut, I think that's probably not going to be the case, because I feel that inflation is going to move in the right direction. And I also think that if the Fed continues to stay on this path of being data dependent, the risk of a recession in 2025 grows.
No, but one second, Peter. You said the Fed thinks that there's going to be only one rate cut. That's not what you reckon. Do you think there will be more than one this year, or not at all?
I think if we see inflation for June and July go down and head the right direction, I think we will see 2 rate cuts this year. And so we could probably see one in September, and then the next one in December.
Right, Peter. What are the immediate challenges at the moment, and what are the top considerations for the next couple of meetings when it comes to the Federal Reserve?
Well, yeah, like I said, the next meeting obviously, they're going to probably repeat what they said today. Look, the Fed has been quite consistent. Since inflation reversed course, they've been basically giving the same message to the marketplace, and that is, we are going to be cautious. We don't want to make a mistake. They don't want to make a mistake on cutting too soon, and they certainly don't want to make a mistake on keeping rates elevated too high. The risks are on both sides of the equation. So I kind of think that, it all depends on the inflation news and obviously the labor, the strength of the labor market. And the key to the labor market is wages. If wages modestly move higher or stay around these levels, I don't think that's going to be a problem for the Fed.
Yeah. So that's the optimistic outlook, which is great. I think other houses as well have 2 rate cuts still penciled in. We'll wait and see. PPI data out tomorrow will also be crucial. Thank you, Peter Cardillo. Pleasure as always speaking to you. Before we hit that break, let's listen in to the Fed Chair talking about the job market conditions, something that Peter was just mentioning. We'll come back with the FNO setup on the other side.
Overall, a broad set of indicators suggests that conditions in the labor market have returned to about where they stood on the eve of the pandemic, relatively tight but not overheated. As labor market tightness has eased and inflation has declined over the past year, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. But these projections are not a committee plan or any kind of a decision. As the economy evolves, assessments of the appropriate policy path will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we're prepared to maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly, or if inflation were to fall more quickly than anticipated, we're prepared to respond.
Welcome. This is India Market Open. We are taking stock of the futures and options space and how things have fared there. Well, consolidation continues, at least as far as the Nifty is concerned, continuing to trade around the 23,300 mark. Yesterday was a day of trade where we didn't see too much, a 0.25% up move for the benchmark. And, well, when it comes to the open interest, very little change as far as futures are concerned. The Bank Nifty, we actually saw unwinding to the tune of nearly 5%. But remember, yesterday was also the weekly options expiry. Perhaps to a certain extent, this had something to do with it. But we saw a 0.4% advance for the Bank Nifty as well yesterday. Now, today is the Nifty weekly options expiry. And while we had mixed cues coming in as far as your overall change in OI is concerned yesterday, moving into today, we're still keeping an eye on our roughly 500 point odds range, while 23,000 put is where we've seen a substantial amount of accumulation, and that potentially could serve as a little bit of a base in today's day of trade. On the higher end, of course, we do have substantial amount of writing around the 23,400 and 23,500 calls, and that would potentially provide you with some amount of resistance on the higher end. Not completely ruling out a very sharp up move, but should we in fact see more strength on the Nifty today, and perhaps if it does sustain about 23,400, 23,500, you never know, we could see a lot of these calls being covered. But let's move on and talk about stocks then. And yesterday, again, it was a mixed day of trade, even though we had more gains than losers, more gainers than losers, pardon me. And of course, we did see longs in Sun TV, Ambuja Cement, Crompton, shorts for Pidilite, as well as Interglobe Aviation, and among stocks which saw unwinding, about a short covering for Container Corp, Balrampur Chini, as well as ABP India. And on the other hand, we saw a little bit of longs unwinding for GMR Airport. So these are some of the cues that we're keeping an eye on. But now that we have the big event out of the way last week, now that the dust has settled, we are looking at a lot of these benchmarks consolidating at the moment. The question really is, what do you do with them now going forward? Well, we have Rahul Ghosh of Hedge.in who's joining us on the show. Rahul, good morning. Thanks so much for joining in. What's your reading now, and what's the way forward when it comes to the benchmarks?
Good morning, and thank you for having me. So the current reading on the benchmarks is that the upside is very limited. At 23,400 or thereabouts where we are, we don't see more than about 350 points on the upside. But if you take the second half of June and the July series, we expect that markets might consolidate and have a small downtick as well. And when I say small downtick, we don't expect anything major. We don't expect 22,500 to get breached on the downside. But yes, a small downtick or profit booking is generally what is on the cards and is expected.
All right. So based on that, what kind of an option structure are you deploying, Rahul?
So exactly keeping this view in mind, we've come up with an option structure where what we're doing is we're buying the 23,300 put, but of July series, because we want some time in hand, even though there's about 15 days in June. That's not enough. So we need some more time in hand. So 23,300 put option of July, it's fairly liquid. We go ahead and buy that. This gives us room for the trade to play out. The premium with today's gap up should be approximately around 320 odd levels. To offset this premium, we are using the 4th July expiries. So the first is 23,300 of end July. And to offset this, we're selling 23,000 of 4th July and 22,000 PE of 4th July once again. So I'll repeat, 2 puts we're selling for 1 put bought. The 2 sold puts are 23,000 4th July expiry and 22,000 4th July expiry. A combination of these will give you a premium of approximately 180 odd rupees. So the outflow is about 320, 330 and the inflow is about 180. But mind you, because it's the 4th July expiry, we can gain back some more premium by selling the rest of the 3 weeks of July expiries to make the trade as close to break even in case markets do not move on the downside in June and July. So a little patient trade, but very high probability. Why? Because in case markets don't move down, you barely lose any money because you keep buying back the bought premium with the sold puts. And in case market remains sideways or goes down, you tend to profit on the downside.
All right, Rahul, so then let's talk about adjustments now. Firstly, if you could tell us the horizon for this specific option structure. Also moving on, if we do need to roll over the 4th July puts onto the subsequent week, under what circumstances would you do that?
So the only time we would roll over the 4th July puts is if Nifty stays above 23,300, which is our anchor strike. And we've come to the end of June, or we've come to the 4th of July. Till then, it's just a patient game. The trade needs to be open till July. It's not a trade for the month of June. So how the adjustment would work is we would buy back the 4th July sold puts, which would essentially expire worthless because markets did not move down. The trade went against our view. And we would sell 11th July expiry. On 11th July, we would buy back the 11th July puts and sell 18th July puts, and so on and so forth. Every time we do this, we get back some amount of credit. What that essentially means is our risk keeps coming down with every passing week. So even though the holding period is slightly longer, the risk is very negligible owing to majority of the premium being made back by us by the sold puts.
And if you could tell us about the consideration in terms of risk and reward per lot here?
The risk is fairly low. What we've done is we've kept a stop loss at 22,200. We don't expect the markets to go to 22,200. If you remember, I mentioned 22,500 is where we expect the markets to correct to if there is a correction. At 22,200, you can take a stop loss and exit the entire position. Depending upon the time of the month, we expect the risks to be about 100 to 150 points in Nifty, which would be about 1,500 rupees a lot approximately for I beg your pardon, between 1,500 and 2,500 rupees a lot, which is about 70 to 100 points. And in terms of reward, once again, depends on the time of month you are. If you're very close to 4th July, your reward can be as high as 4,000 to 5,000 rupees, but an average reward to expect should be around rupees 3,000, which is double of our risk, which is acceptable.
All right. So that's as far as benchmarks is concerned. Rahul, any stocks on your radar at the moment?
Yeah. Also wanted to inform viewers that the strategy last week, which was on the bullish side, once again paid off really well once again. On the stocks front, Dixon Technologies is something that we continue to keep our eye on the equity side and on the options side. So Dixon Technologies, what one can do is above 10,400 in spot. It's currently around 10,330 if my memory serves me right. We can buy the 10,500 call of June end expiry and sell the 10,600 call of June end expiry. This would be a simple bull call spread with 10,500 and 10,600, with the caveat that we enter this once prices cross 10,400 on the upside.
Absolutely. Straightforward strategy there. And Dixon Technologies on the radar of several traders who actually deal in momentum, cross-section momentum specifically. And of course, Dixon Technologies is now starting to pop up in some of those scanners. So we'll continue to keep an eye on that one. But Rahul, on that note, taking a moment to thank you for joining us and taking us through your views on the markets, helping us how to employ and use options in such circumstances, and also giving us that call on Dixon Technologies. With that, it's back to you, Tamanna.
Yep, and Kunal Rambia is joining us now. I'm also joined by Neerav Ashar. Kunal Rambia is founder at The Street. Neerav Ashar is head of equity research analyst at Latan Manharlal Securities. Welcome to both of you, and thank you so much for speaking with us today. Let me come to you, Kunal, first on what you see as the levels today on the Nifty and the Bank Nifty. We've had a positive close yesterday, but overall I would say a bit of a subdued day of trade. What is your outlook?
Morning, everyone. Thank you so much for having me on the show. So if you look at the overall trend of Nifty since December 2023 so far, it's been overall positive. Every decline is seen as a buying opportunity because consistently Nifty is making higher top, higher bottoms. And what we saw was on the exit poll date when the Nifty made the new high, we are back to the same level within just 2 or 3 days of correction and the reversal. So so far the trend remains very much intact and very much positive. But if you look at the very short-term behavior, it's been 3 days the Nifty is struggling near 23,350 kind of levels. Now what are we supposed to do is just keep an eye on this resistance level, which is at around 23,400. If Nifty manages to close about 23,400, I think 200 to 250 points more on the upside is very likely. On the lower end, 23,200 seems to be the good support. That's 120 points away from the present level. But yeah, broadly, even on the short-term horizon, Nifty is looking more or less positive and the trend remains intact. Buy on dip can be a good strategy.
Okay, buy and dip is the strategy over here. If we see the dip or not, we'll have to wait and see. Kunal, what about your top picks this morning?
So I'm looking at a couple of stocks and those are from the different sectors. The first is NFL. If you look at this counter, it gave a good momentum just a couple of days back. It was up around 12%. Right now it's trading at around 112. I think with the stop loss of 105, one can think of initiating a buy on this. The stop loss can be 105 because that's because of the volatility. The target can be 130, and advice is to trail the stop loss when the target is achieved. The second is a Hindustan Copper. Again, this counter is broadly recovered from the extreme lows of 4th June, consolidating in the sideways narrow momentum. Yesterday was a good momentum again. With the stop loss of 325, one can think of buying this with the target of 365. That's a positional target again. And the third one is LIC of India. Now, again, this counter recovered sharply, consolidating near 1,000 levels. So with the stop loss of 970, one can initiate a buy on this. The target can be 1,050. All three counters which we discussed, one can initiate with the positional mindset. If the target is achieved, revisit our channel and keep asking for the new views. I think trailing stop loss will make a lot of sense for all three counters.
Say our channel, Kunal, you mean our channel, right?
Absolutely, absolutely.
Okay, just making sure. No, on a lighter note. I'm going to ask you about all the insurance counters as well because that's the buzz this morning, Nirav. But let me start with your overview. And do you think the insurance pack will be in focus? How do you see this whole surrender value story? Do you see it as a negative? HDFC Life has come out and said that they're going to have maybe 100 bips impact on margins. The bigger players may benefit. SBI Life seems to be a hot favorite. How do you see the whole development?
Yeah, good morning and thank you for having me on your show. I think as you rightly pointed out, the surrender value, the increase in the surrender value, the revision in the surrender value, definitely it's going to impact the smaller players. But if one were to look at the players with a larger base like LIC of India or SBI Life, ICICI Pru also to a certain extent, I think they may actually end up being beneficiaries to some extent. And as you rightly pointed out, I think HDFC Life, for them it's going to be a slight dent. But overall, I think they should be able to tide through this development.
Nirav, you can come in on the cement sector. Now, yesterday we had a handful of brokerages which suggested that price hikes for the cement sector are on the anvil, and because of that, there could be a potential inflow of course, improved cash flows for a lot of cement companies going forward, notwithstanding the seasonal effect that monsoons could play on the cement sector. What's your overall view and any of those names that stand out for you here?
Well, as far as the cement sector is concerned, we've been hearing stories that there's going to be a price hike. In some cases, price hikes were announced in certain regions. And as you know that cement is a very region-specific business. And quietly, some price hikes had to be rolled back also because the market did not have the capacity to absorb this. Also, there is a problem of surplus capacity and demand getting muted at some points of time. This quarter, the last quarter has been the pre-election quarter, and now we will be having the monsoon. So construction activities generally tend to be subdued during this point of time. So I think I wouldn't subscribe to this theory that the price hikes might hold on. But looking at the other side, I think we are looking at cost optimization being a strategy which could work for companies. So from that perspective, we are more confident about the prospects of companies like UltraTech Cement and Ambuja Cement in particular. I think we had highlighted this earlier also, that Ambuja Cement is working very hard on the cost optimization side. And I think these are the companies, Dalmia Bharat is there, or Shree Cement is there, UltraTech Cement is there, Ambuja Cement. They're working very hard on the improving their EBITDA margins, improving the share of waste heat recovery system, and trying to control their cost by using synergies, various group synergies as well. So I think these are the companies which should benefit rather than those companies which are expecting a rate increase in the rate.
What's your top pick from the cement pack, Nirav?
I think I'll go with Ambuja Cement.
Okay. Ambuja Cement is your top pick. Kunal, you have a view on the charts for Ambuja?
Absolutely. So if you look at the overall cement pack, I think they are doing pretty good. Especially the Ambuja Cement, if you look at the structure, the counter recently showed a really good momentum. The trend remains positive from December so far. The counter is near to the previous peak, that's of around 3rd June. Again, that's the temporary resistance on the chart. I think once 675 is taken out, the counter is ready for 725, 730. We have to maintain the stop loss at around 750. For the improved volatility and the risk management part, but otherwise I think 725 is likely on the chart.
All right, so that's as far as the cement sector is concerned, but let's talk about FMCG now. And well, from what we understand, the Nestle India will continue paying general license fee or a royalty at the existing rate of 4.5% net of taxes to its Swiss parent. We have our colleague Mahima who's joining us to give us more perspective on this one. Good morning, Mahima.
Good morning, Agam. So as you rightly mentioned that Nestle will continue to pay royalty at the rate of 4.5% to its Swiss parent. Well, in the previous time, it was proposed that the royalty will be raised from 4.5% to 5.25%. However, 57% shareholders voted against this proposal. About 71% of public shareholders holding 37.24% voted against the resolution. Now, basically, promoters hold 62.76%, but promoters are ineligible to vote because of the related party transaction aspect, and hence the entire notion was taken down. Going forward, they've also said that approval of board will be required in order to raise this royalty from 4.5%, and this will be considered every 5 years. Now, just to give a perspective of how other FMCG companies pay royalty, Colgate pays around 4.5%, Procter & Gamble pay around 5%, Hindustan Unilever pays around 3.45%. Now, in terms of Nestle's stock performance, the stock has been up around 4.5% since 4th of June. However, 6 months it's been down around 6.8%, and 1 year it's been up around 13.8%. The stock has been under some kind of pressure since the past 6 months. So today the stock might see some kind of upside because keeping the royalties at 4.5% will keep their margins intact.
All right. So Nestle, I think good news is you don't have to pay more royalty. But is that enough of good news is the question. Nirav, any view on Nestle? Which, if you had to go in for a longer term view on this whole consumption play, would Nestle be in your top 3?
Yes, definitely. And I think we've seen till now in the FMCG more talk about the green shoots of recovery as far as the rural economy is concerned. But I think Nestle is more urban-centric. So I think from that perspective, the demand tends to be quite strong. And we have the premiumization play, which could also come into effect. Apart from this, the stock has been split also. And we have the royalty, which has been kept at 4.5%. So I think that would be a big relief as far as the shareholders are concerned. And I think more or less we should see a positive reaction as far as the near term is concerned. But I think I will wait for the quarterly results also to confirm whether there has been a real tangible recovery which is seen in the FMCG space. But overall, I think we continue to like Nestle and HUL in this particular space.
Talking about Nestle and the way things have panned out for this particular company over the last 6 months, and I talk about since the December, it's exactly where it was back in December. Sure, it has gone up and you moved above the mark of 2,700 rupees per share at one point in time earlier in Jan. But there's been largely consolidation, and well, I'm looking at the weekly chart, and there's just been a very, very slight tilt towards the downside in terms of a trend. But I'm going to hand it over to Kunal to ascertain whether or not that is in fact true. So Kunal, what's your assessment on Nestle at the moment?
See, Agam, you made my life a little easy by explaining the entire thing. Yes, from 2750, the counter is down. December, Jan 2024, it was at 2750. The second high was somewhere near to April, where the counter came down and made a low, the lower high, I would say, at 2725, and right now it's at 2550. So overall trend is, in the recent times, the trend is negative. But if I look at the weekly chart, from longer term perspective, the trend remains absolutely intact. So if someone wants to play the momentum on this counter, I would say wait for the breakout of 2600. If the counter manages to go about 2600, then 2750, 2800 are very likely. If someone wants to play positional bet on this, then I would say wait for consolidation and let's wait for the counter to reach support that's at around 2450 and accumulate near that level. In all senses, the trend is positive. One can definitely accumulate this counter from long-term point of view.
All right, Nestle looks interesting. Kunal, very quickly, anything else in that entire pack that you like? HUL, CP, Dabur, Imami?
Yeah. So I actually shortlisted ITC in the entire pack. The only reason being recently we saw the consolidation again, and the counter is really near to the breakout zone itself, and that's at around 440. If counter manages to go above 440, I think the first target of 465 and above that 495 is very much likely. So yes, I'm very bullish on ITC. I'm just waiting for the breakout of 440.
Okay.
All right. Well, moving on, as far as, well, of course, that's the FMCG pack, but I'm going to perhaps revisit how things are faring as far as the insurance sector is concerned, and want to take a look at, well, SBI Life Insurance and HDFC Life Insurance. Of course, two of your larger insurers. I'm not talking about LIC in this case because that's a giant. But, in terms of how things have panned out over the last few weeks, again, this is where it's turned out to be a frustrating, investment over the last many, 3 to 4 years. We really haven't seen as much traction there, and I reckon a lot of investors are just waiting by for something to happen in this sector. Authorities and rules in general have not been in favor, but the real question is that is there any scope of some sort of a positive traction going in? I'm going to take this up with Kunal. What's your assessment? Let's talk about HDFC Life and SBI Life here. What do you see?
See, Agam, I'm very bullish on HDFC Life. The reason being, if you look at the chart since inception so far, that's from 2018 so far, this counter made 5 bottoms. The first bottom was somewhere in 2018 near 300. Then the second bottom was in 2019 near 325, 345, 380 somewhere in 2020. 490 somewhere in 2023, and recent bottom at 540. If you connect all the bottoms, the trend is absolutely intact and it's just taking the support on the trend line itself. If you look at the daily chart, it made recently 2 equal bottoms near 540. I'm very bullish on this counter. If HDFC Life manages to cross above 580, I think it can be a complete bounce and a turnaround. From the midterm perspective, the targets can be as high as 650. So that's a view on HDFC Life. One can think of accumulating. Just keep the stop loss of 540, and any zone between the present level till 540 can be a good buying opportunity.
All right. So we're talking about insurance, but why are we talking about insurance? Puneet is joining us for more on this. We'll also be speaking to Harsh in just a second, who's live from the Morgan Stanley conference this morning. So we'll get a take there as well. But Puneet, for now, what we understand is that IRDAI has issued rules for surrender value. That story on our website as well, where they have asked to facilitate loans against their policy too. But for now, we'll talk about the increase in surrender value that IRDAI, the regulator, has mandated. What does it mean for life insurance companies? How will it impact?
Well, that's right. So these rules have been going on for some time now. There has been a lot of deliberation on it. And essentially, what surrender value is that, it's the amount payable to a person who will give back the insurance policy to the insurer. And that amount has been very low comparatively. That's what the regulator has been saying. So IRDAI has been proposing better surrender value terms. And now those regulations have come in. So let me just go on to the brokerages of what they are saying. So Nuvama has said that, special surrender values are expected to rise from this particular level. The regulations have been changed to avoid any kind of mis-selling and protect insurer policy interest for the policy holders as well. They've also said that the surrender values will indirectly increase any kind of commission that insurance would have generally paid. So they are seeing some commission stress on commissions going forward. and lower commission payout shall, aid larger firms such as HDFC Life and SBI, which we were talking about. There could be some impact on growth. That's what Nuvama thinks. This will be a little difficult to assess at this point of time since the regulations are just coming. So a lot more details on disclosures and other factors are seem to be looked at. And for Nuvama, they see HDFC Life and LIC as well as the other players to benefit, but there will be some more traction that will be needed. And finally, just on MK, they have said what are the key changes here. Basically, this includes that surrender value will now be given after the first premium payment, which was a key contention that these insurers had. They have also said that any kind of discount rate will be decided now on 10-year GSEC, which I think Harish can talk about a bit more, plus 50 basis points, and this is a key positive for the insurer. So MK likes HDFC Life, ICICI Pro as well as SBI Life here. They see roughly 20 to 27% on positive upside from here.
Right. Thank you for that, Puneet. And you're right, we'll get more perspective on that from Harsh, who's joining us live from the Morgan Stanley India Investor Forum. So an interesting morning there, Harsh, and of course we'll be looking forward to all your conversations there as well. But I know that you look at this sector very closely. And what really is going to be the changes that large life insurance companies will have to make?
Well, the biggest shift is going to be in terms of the fact that the minute you're taking an insurance, the first year after you take the insurance, you're not allowed to exit it. And if you do exit it, you get no surrender value as a consumer. That changes in a big way currently. So basis the current or the existing regulations as of yesterday, that was not permitted, or what terms most life insurers were giving was there will be no surrender value given to the consumer or the policy holder. That changes in a big way, because what the current regulation now says is the present value of everything that a consumer or a policy holder has paid, in discounted of course, so in present value terms, needs to be returned back to the policy holder in a fair and transparent manner. Therefore, what they are seeming to suggest is that earlier, where life insurers would not be paying anything when an insurer or policyholder exits his policy, now there is a regulation of a minimum threshold of payment that a life insurer must do. And that is a big positive, according to me, for the consumer and the policyholder. The other aim of the insurance regulator is to try and streamline and avoid or limit the mis-selling of life insurance products. This will likely lead to that as well, because you have upfront commissions which are paid out, which are fairly large, and therefore the fact that the policy might get surrendered will avoid any mis-selling. So the life insurers will want to underwrite longer term policies because that will benefit them more. And in case a policyholder cancels his policy, it will in fact be a burden on the life insurers. The impact with regard to margins here will be key, because upfront commissions are large, and therefore any kind of mis-selling or any kind of withdrawal from the policyholder will lead to a slightly chunky loss coming through for life insurers, and therefore impact profitability and margins. Of course, it's extremely interesting, but it's also very difficult to assess which insurers will be most impacted. So that's still a limbo, but we'll obviously have to analyze that more. Of course, Nuvama, Citi and MK coming out with their views and expressing the difficulty in ascertaining which ones will get impacted the most. But HDFC Life and LIC basis FY24 numbers seem to have been impacted, but also HDFC Life has a long history of being able to adapt very well in terms of changing its terms for products. So will be an interesting space to watch out, especially commentary coming from insurers.
Right. Harsha, well, thanks so much for all those insights and updates, but just hang on. Well, you are at the Morgan Stanley conference for this year. What are the key takeaways that you're going to keep an eye on? What are you going to look forward to? And also, if you could tell us about the conversation that you're having.
Well, Agam, it's an extremely interesting inflection point, because you're already seeing the CPI inflation come lower. You're also having conversations around the rainfall this year, because that will essentially impact agri, and also the election results. So there have been 2 to 3 big macro factors which are obviously going to play out in all the conversations that we are having here. The other piece, of course, which I'm going to more specifically focus on is with regard to banking and financial services. Where do banks go from here? Of course, rate cuts likely on the anvil, some projecting 1 rate cut, some 2, but nonetheless, the rate cuts are on the anvil, and therefore, which are those banks which will disproportionately benefit from these rate cuts is something that I will be really, really keen to understand. And of course, we'll have that conversation in just a few moments.
All right. So we look forward to all of those details. Thank you for that, Harsh Saita, there this morning at the Morgan Stanley Investor Conference, and we'll get all those updates and conversations from him. Meanwhile, pre-open rates kind of settled. Let's get the first take in from Kunal and Nirav. Sun Pharma up 10% now. So a lot of moves over there this morning. HDFC Life was doing fairly well. Nestle showing a positive kind of a move. So now HDFC Life down in the red. So we'll have to wait for those rates to settle. Nestle I see as positive. Maybe some relief there coming in on the fact that they don't have to improve their or increase their royalty rates. M&M, some of these counters. I just want to see what's happening with Interglobe and L&T Finance. Both are block deal candidates today, and we'll be seeing some stakes being paired. Interglobe already saw from its one of its promoters, but does that continue? Nothing ticking on L&T Finance yet, but that's one to keep an eye out for. Kunal, anything that you're spotting or you want to add on to your first hit of morning trades after seeing the pre-open action?
See, I think FDC is looking attractive. As of now, if you look at FDC price, it's showing that it's almost up by 0.5%. If you look at the recent behavior, the counter recovered from 420 levels to almost 460, and it's in the positive trend itself. So considering that, I think with the stop loss of 445, one can think of initiating a buy on FDC after the recent numbers which were published. I think the company is doing good on the pharmaceutical front also. With the target of 485, one can think of buying FDC. The stop loss can be 450 for now.
I was just looking at 361 WAM, one of the stocks that we picked this morning, and that's also not seeing a bad, pre-open trend at all. About 3.5%, nearly 4% up on the acquisition of ET Money. So those are some of the stocks. Let's look at Sobha. You were talking about it, Agam. Let's see how Sobha is doing this morning as well. That's about 2% up, but nothing massive changing, perhaps, as far as the first rates go. HDFC Life now in the red. I want to take a look at some of those other insurance plays. Are we seeing anything clear on SBI Life yet? What's happening with LIC? Some of those to watch this morning. Kunal, any of these that you are tracking or that you like at these levels?
See, let's just wait for a couple of minutes to settle down in terms of price. As I discussed, I think I'm very comfortable so far with LIC and HDFC Life. We'll see how it opens. I think we'll be able to share the levels better with our viewers. Just a couple of minutes.
Well, I actually want to take up the real estate sector with Nirav, if we could, because we're still seeing, a lot of these companies still trade at life highs. And I'm not saying that I'm surprised, but now there are some questions being raised with respect to their valuations. Sure enough, there is a lot of visibility with the kind of projects that are already lined up for a lot of these companies, and especially when inventory levels are reducing, month on month. But Nirav, going ahead, do you think that some caution is now warranted when it comes to the real estate sector, or do you still think that things are not as bad?
Well, I think things are not that bad, and I think the demand continues to be quite robust, and we've seen the aspirational value of real estate and how things have changed after COVID. So I think continue to remain positive on the real estate story. And on their side, on the company side, they have also undertaken a lot of efforts like deleveraging exercises, improving their cash flows, getting the projects to be executed in a timely fashion, etc. So I think that the dynamics of the sector have changed drastically, and I think this trend is likely to sustain in the near future.
All right, that's the story with Godrej Properties, one of the real estate plays that is working. Meanwhile, if you look at what's happening in the pre-open rates, which have settled now, you are perhaps looking at another day of muted kind of trade, at least in the first few minutes. We'll wait and see. Not too much of action, but definitely in positive territory. On the frontline stocks, Nestle about 2.5% up, the biggest gainer after the pre-open rates have settled. Ultratech, M&M, all of these are going to be in focus through the day. Dr. Reddy's as well. Dr. Reddy's, we told you one of its arms have had a tie-up for a new injection cancer for treating various kinds of cancer in the US. So that's doing okay. Nirav, would you look at the pharma space right now? Divi's, Dr. Reddy's, all of them in focus this morning?
They're looking attractive, but I think my focus is on Biocon at the moment. I think the stock has given a very good up move and it's given a good guidance going forward. So I'll be more stock specific in the pharma space with a focus on Biocon especially.
All right. Well, now that we have the pre-open, which has been settled, it's very close to the 23,500 mark, and perhaps Kunal can confirm this for me. Kunal, we are looking at a lot of call accumulation around 23,500 and that particular strike. Should we see some strength in open? What's your assessment? How would you go about, your intraday trading, considering today is also the Nifty weekly options expiry?
So, Agam, this weekly expiry is turning out to be like a problem for the trend followers, especially now because we have seen a lot of open interest near 23,500 mark and Nifty is opening right near that level. If after 15 minutes, so it's a very simple strategy which I advise to everyone, that after 15 minutes, if the high is taken out, then just wait for the consolidation and stay with the bullish momentum. But if the low is taken out, I'll be the first one to short. So 23,500 itself is the strong resistance. If the Nifty manages to stay above that for at least 15 to 20 minutes, I'll stay long. Otherwise, this will be the high where I'll start shorting at least for intraday, and the targets can be 23,350.
All right. So that's the strategy on at least the index as we see. But let's talk about L&T Finance for a second. Kunal, is this something you're tracking? The block deal news, of course, today. Stock has done fairly decently in the pre-open session as well, about 2.5% up. Would you initiate a trade at these levels?
Absolutely, Tamanna. We shortlisted this counter. If you look at the historical data from Jan 2024 so far, counter has tested 175 mark almost 7 times. This is the 7th time when the counter is again reaching back to 175. Managed to close above 175. I think we can see the targets of 195 to 200 levels. So I'm very bullish. I'm just waiting for a closing above 175. And today's trade, it's opening up by 2.5%. So if it manages to stay above that level for even if 15 minutes with the day's low as a stop loss, one can definitely buy and the targets can be 200.
Okay, target of 200 on L&T Finance is what Kunal likes right now. I'm looking at an LIC. Any interest in an LIC, Nirav, at all? While we're talking about the whole surrender value impact, how does an LIC play out for you? It is still the largest in the space in terms of market share, by a stretch, actually.
Yeah, I think we remain positive on LIC because of the base effect, the scale of operations, and its ability to adapt to the changing market conditions. So I think remain positive.
Nirav, a quick question on how defense is panning out right now. Names like Bharat Electronics and something like a Hindustan Aeronautics, even from the shipping space, something like a Mazagon Dock, after the 4th of June, which actually did see a very sharp cut there, we're now starting to see a little bit of recovery here on. What's the way forward here?
Actually, I think the indigenization of defense is a theme which is inevitable, and there's a lot of thrust by the government on this particular aspect. And if you look at the order books of all these companies, they're absolutely full. If you look at the shipbuilding companies, I think the government is very, very serious that they want to take the indigenization element in the shipbuilding to approximately 75%. So it's already touched that 75% at this point of time. Plus, the order books of all these companies are absolutely full. The margins have been improving. And if you just see the latest quarterly results, the execution has been very, very strong and the visibility remains very, very strong. So I think there are no two ways about it. We are definitely going to see uptick in all these shipbuilding stocks. As far as HAL is concerned, they have also gone on to say that their order book is close to 95,000 crores at this point of time. So just look at the revenue visibility over a period of time. Execution is going to pick up. They've clearly said that they want to scale up the production of the light combat aircraft in this particular year. As far as Bharat Electronics is concerned, they had an order book of close to 75,000 crores. In FY25, they are looking at order inflows of 10,000 crores, plus the missile programs which are slated. And even they've got visibility as far as FY26 is concerned. So there is a huge amount of order books which these companies are staring at, and I think margins should not be a problem. Execution should not be a problem. There's a complete boost as far as defense is concerned. So I think these stocks should continue to do well.
Kunal, a 15-second answer on your top pick this morning before we hit the first rates.
The first is India Bulls Housing. I think this counter has given yesterday's breakout. Today also it's opening near to the high itself. So with the stop loss of 165, one can initiate a buy with the target of 200 as a positional target.
Okay, so that was even more efficient, not even 15 seconds, but India Bulls Housing is a top pick of Kunal. Now, just 20 seconds before we count down. Remember, it has been a calm after the storm. That's how I would describe most of the trading week. We're already on Thursday, but the big trigger this morning is definitely still going to be what the Federal Reserve's outlook has been. It's been less hawkish than expected. Will we see that move in IT stocks over the day? Overall, Asia has also been positive. All right, first hit rates hitting here for the markets and definitely up in the green, 23,400 and above, fairly comfortably. Are we going to see 23,500 levels? We'll wait and see. Bank Nifty not looking bad at all, above 50,000 and comfortable over there as well. The mid cap and small cap actually showing more signs of life, about 0.75% for the small cap, for the mid cap and the small cap, both indices up. Let's pull up the heat map and see what's buzzing this morning in trade and where really the action is. We talked about Nestle in our trade setup, and that really is top of the pack, at least on the front line of the Nifty 50, about 3% up. The reason is that their royalty rate that they're going to transfer has stayed unchanged. That means no additional hit on margins for Nestle. That's good enough. But the fact that it's the top pick also shows that the market is being a little careful today, playing it a little defensive in that sense. LTI, Mindtree, Ultratech, all of them doing okay. We talked about IT being the flavor of the morning, and that seems to have worked out exactly as we said it. LTI Mindtree is up there. So is HCL Tech, Wipro about 1% up. So, you know, that definitely is working out. We talked about Dr. Reddy's also. Dr. Reddy's having a good morning. And remember, they have their arm has tied up for a new drug in the US market. It's an oncology product. HDFC Life in focus. Remember, as the dust settles on the entire surrender value game, HDFC Life is one of the top picks. They also came out early enough to say that they welcome the new surrender policy and will just have a very marginal hit on their profitability. So HDFC Life now quickly moving towards the top position, but still about 1.5%. Not too much red at all, Agam, this morning. Just 4 counters there. That to an HUL, Britannia, Tata Consumer. So it's a consumption space. So Nestle is up there for a very different reason, but the rest is really in the consumption space. Apart from that, you're not seeing a bad morning at all, and IT in flavor.
Absolutely, absolutely. Well, see, you know, we were actually taking stock of how things are panning as far as the broader markets are concerned too. Something like a mid-cap index or a small-cap index, you know, it should be interesting to see how things are faring there. So while we are looking at a 0.1% advance for the mid-cap and the small-cap indices, let's take a look at what's really happening as far as broader markets go. And among stocks which are in focus on the back of news, there are a handful of them. So we start by taking a look at 360 WAM, and that's where we've had some cues coming in. We're in fact looking at about a good 2.3% up move there. Soba's up as much as 4%. Of course, we have more details with respect to the rights issue coming in. And, it does seem like a lot of traders are at the moment, and investors for that matter, everyone who'd potentially be interested in the rights issue, buying into it. And L&T Finance, of course, on the back of the block deal, we're looking at a 3% uptick there as well. A couple of counters on the back of order wins. So we have something like a Gensol Engineering, which is also advancing by as much as 5%. In fact, it's locked in an upper circuit of 5%, as is the case for Bondada Engineering. So these are two relatively larger orders for both these companies of the relative size, and that's the reason why it does seem like we're seeing an upper circuit for both these respective companies. And taking cues from yesterday, we have two other counters which were buzzing in trade yesterday. Let's see if we have a follow-through buying coming through. It does seem like Gravita India is looking at a bout of profit-taking, at least earlier in the session, as is the case for Elecon Engineering, which is down 2.5%. Remember, both these counters were up anywhere between 6 to 10% yesterday. It does seem like it's taking a breather in today's day of trade. But on the whole, if you consider your broader markets, Tamanna, both the mid-cap and the small-cap indices will continue to outperform the benchmarks like the Nifty and the Bank Nifty.
Absolutely. A lot of specific news-driven flow this morning, I would reckon, Agam. So, Sobha, you talked about, but look at macro tech as well. About 4.5% up. Sugar stocks have been in focus. Sri Renuka, about 5% up. And we're going to be speaking to the management ahead on the show as well. So stay tuned for that. Quick programming reminder. L&T Finance, I wanted to look at. So L&T Finance is seeing a block buying today. And that stock is doing fairly well. That was on Kunal Rambia's radar as well. Paytm I want to pull up. So this has had some interesting news. They've tied up with Samsung, and the Paytm services are going to be available on the Samsung wallet. So enough to show some enthusiasm in that stock this morning. Now on the sell side and on counters which are not working too well, if you pull up that entire list, you will see the entire FMCG pack. That's definitely the theme and the mood this morning's Marico, Dabur, Godrej Consumer, HUL, Colgate, Britannia, all of them in the top loser category on the BSE 500 at least. Sanofi, of course, on top of that pack though. PVR, Inox. So one reckons that the whole consumption theme has eased off. A bit of profit booking there, maybe on a set of stocks which had done fairly okay. Remember, our expert stock pick over there was, in fact, ITC. But the others are not doing too well at all this morning, and that's the big theme. Kunal, let me come to you on what you've spotted after the first rates have hit.
Tamanna, I think market is doing fairly well, and most of the counters are doing good. I think PSU banking sector is looking attractive as of now. If you look at IOB, it's trading at around 68.70 and it has given a gap of open, and I think it's trying to come out of the consolidation. So by any chance, if the counter manages to sustain at the present level with the stop loss of 67, one can initiate a buy, and the first target can be 75, which we saw as a high somewhere in the mid of May. I think that counter is looking fairly good as of now. And the second is Kokoyu Kemlin. You can check that counter that's trading at around 150, 1.5. It's been 4 to 5 days consistently. This counter is outperforming from the extreme low levels. It has come up really well. So with the stop loss of 145, one can think of initiating a buy on that also. And the targets can be 165 again.
All right. So those are two interesting picks. I just want to take a look at what some of the railway stocks are doing this morning. Jupiter Wagons again about 3.5%, 4% up. Let's pull up Titagarh, Ircon, that entire pack and see if that's a broad-based kind of a trend. Yes, it seems to be. So that continues as well. Ircon fairly flat. But, those are Railtel, etc. Those are some which seem to be in focus this morning as well. Nirav, your first thoughts after the rates have hit, and anything that you would pick as a theme for the day?
I'd like to look at the sugar space, and I think with the revival of the monsoons, and I think expecting a good monsoons this time around, I think should boost the prospects of the sugar sector. So most of the sugar sector stocks have been beaten down. So it's a good time to have a look at them. Stocks like Balrampur Chini or Bajaj Hindustan, Dhampur Sugar, etc. can be had. Definitely we can have a look at them. And I think IT continues to do well, and selectively would like to look at stocks like HCL Technologies, Tech Mahindra, which look attractive.
Nirav, what we're observing is also recovery in some of your capital good companies like Siemens, Thermax, as well as ABB India. They've all had very, very strong quarters. In fact, before that sharp knock on the 4th of June, we also saw a sharp correction. But since then, we've seen recovery in all these counters. Anything that stands out for you among these?
Yeah, I think we had broadly identified two themes and two sets of themes. In the first theme, we had ABB, Siemens, and Thermax. I think all these look quite attractive. There are different plays out there. One is the electrification, robotics, process automation, etc. Signaling, telecom, waste heat recovery, etc. So all these things have played out over there. And the second set is having a look at CG Power and Industrial Systems, Exide Industries, and Amar Raja Energy and Mobility. So I think we like all these 6 stocks, and we are very hopeful that all these stocks will perform quite well in the times to come.
All right, Amar Raja also on the radar. All right, let's quickly go across to Harsh Saita, my colleague, who's in conversation with Sumit Kariwala, India Bank's analyst at Morgan Stanley.
Look at the valuation gap between private and state-owned banks. They've narrowed to historical lows. I'm not saying that state-owned banks are going to surprise negatively on earnings.
Sure.
They will do well. They have improved their loan mix towards retail SME. They've improved some bit of underwriting practices. Some of these state banks are doing very well on technology. So it's not that, come 1 or 2 years, they'll have a massive drop in ROA or so on. They'll continue to deliver earnings, and they can also surprise. There's no doubt, because the cycle is so good. But what will happen is that there will be some pockets where private banks can now outperform on earnings quality, and that is where they can re-rate and get their premiums back.
Understood. Okay.
It's a relative call. State-owned banks will do well, but private can do slightly better, especially given where the valuations are.
Understood. So we are nowhere close to mid-cycle is my understanding of what you're saying. So we still have a very long cycle to go. That's essentially the underlying.
Especially when you talk about asset quality. The only, as compared to previous cycle, the only headwind that I see in this cycle, which is very unique. Historically, bank margins were not linked to policy rates. So we never used to be in a situation where we used to worry about, say, PPOP or margin or fees. And, it was very easy to call banking cycles, just focus on asset quality. When asset quality problems come back, you just sell off the lower quality banks and so on. This is slightly unique and differentiated because now 40 to 60% of the bank's loan book are linked to policy rates.
Yes.
And what is the other thing which I'm seeing is that there is very high competitive intensity in certain lending segments, especially by certain players. And a combination of these two factors will mean that even though the asset quality cycle is good, there could be margin pressure and therefore PPOP pressure at select banks, which could come sooner than expected. That is the differentiating characteristics of this cycle, and that is something which is very important. And this is, again, I'm trying to build on the story that we are talking about, that in some of these headwinds, be it margin, competitive intensity, the private banks can actually do a better job. And that's where this scarcity premium kind of comes back. So when you talk about asset quality, I think so we are in very early stages. When you think about margin pressures, I think so we are somewhere in the mid-cycle. Loan growth, again, very early stages.
Understood. So that's an excellent start. What I want to try and get to now is, and you put it very beautifully, the fact that private sector banks are much better placed for the rate cut cycle, which is coming up, than PSU or SOE banks. And within private, I also want to understand your views, whether small, mid private is better, or whether the larger ones is what what will outperform in this at least margin re-rating cycle. So talk us through some of the factors which one should look out for going into this possible reduction in repo.
Yeah. So let's divide banks into two parts, large banks and small banks.
Sure.
When I look at large banks, and most of the large banks have 40 to 60% of the loan book linked to repo. So whenever RBI cuts rates, right now we're not assuming any rate cut over the next 1.5 years, but whenever RBI cuts rates, there'll be an immediate impact on all the banks. Okay, but banks, when you look at, from a 1 year perspective, banks will be able to recoup a lot of that because the deposits will also reprice lower. But the point is that which banks will be able to manage that transition better. So if you look at private, they've been aggressively shifting their loan mix towards high margin assets. They've been very selective on what kind of assets they are cherry picking. Okay, and to that extent, what I see is that when I look at the starting point of margins compared to historical cycle averages, a lot of private banks have a lot of buffer. So there are banks where margins are 30 to 50 bips higher than the historical averages.
Sure.
This is not something which I see with the state-owned banks. And what will happen is that as you see a potential rate cut cycle, as you see competitive intensity kind of sustain, as you see deposit costs continue to move up, some of these banks will be able to retain their margins still above pre-cycle averages. And that would mean that the ROA, while it's moderating, it's still above cycle averages, and that's a good point. And when they're able to do that, people will say, okay, the ROA moderation for these banks is lower, these banks is higher. And to that extent, again, getting back to the point, that's where you see that some of that scarcity premium build up and reallocation from low quality banks to high quality banks. And so.
All right, you can see that entire conversation ahead in the day on NDTV Profit and, of course, on all our social media sites. So watch out for that. But meanwhile, we'll take a very short break. On the other side, we're talking to India Pesticides on their new plant. They've commissioned an intermediate plant. What is that all about? What's their plan ahead? That conversation after the break.
Welcome back. Where we are taking stock of India pesticides now. Well, we have an update with respect to the monsoons very recently, and we thought it would be a good conversation to have with how the sector is expected to come through based on what we can expect. And going forward, what are the cues to keep an eye on as far as the pesticides industry is concerned. So let's get in the management of India Pesticides. We have DK Jain, Chief Executive Officer at India Pesticides, with us. Mr. Jain, good morning. Thank you so much for joining in. A view on potential in demand going forward. We've been looking at the year gone by. It's not been the most encouraging, at least as far as Q4 is concerned. But do you think that we can start seeing positive traction going in?
Yes, sir. Last year it has been a very challenging year for all the agrochemical industry. But this year now the things are getting better, and we feel that in 1 or 2 quarters it should improve a lot. Last year it has been really a very challenging year in terms of geopolitical situations, overstocking by the MNCs, and slightly bad weather conditions in many parts of the world, and also in India. But now the authorities have predicted normal monsoon, so we feel that Indian demand will be reasonably good and it will grow. And similarly, the geopolitical situations are getting slightly better, and we are getting better orders now for exports also.
Mr. Jain, just, you talked about how it has been a challenging year, and that's clearly showing in your numbers. Your EBITDA margins, I would say, crashed in a sense from 21% to 3% year on year. Net profit was also hit. Let me just talk about where you see margins improving to. You're saying demand will come in because monsoons are seeming fine in India, maybe more focus on rural India from the new government, etc. Where do you see EBITDA margins going back to?
EBITDA margins, madam, it is really difficult to tell exactly where we are going ahead, but it will be better than what we are having present. We expect at least 17 to 20% of EBITDA margin in the coming quarters.
Okay, so you're going to jump from 3% back to 17 to 20%. And where will that boost come from? Because your volumes, which you were expecting to improve in Q4, also did not quite improve. So what is the reason that you're expecting those volumes to come back as well?
Volumes, we are getting good export orders now. Last year, two of our major volume products, the demand was very less. But this year we are getting good demand, and we have got good orders on hand for these products. And apart from this, we have slightly changed our product mix. And in this, we are getting good domestic demand for some of our products. So the volume would come from domestic as well as from exports.
The mix you're expecting split between domestic and exports in your volume mix for Q1 and for the next financial year?
It will be, madam, about 50% export and 50% domestic market. It has been like that only last year. It has slightly changed the revenue because the export market was down very much. But this year again, it is going to pick up, and we would be reaching around 50%.
Right. Mr. Jain, can you tell us a little bit more about your current installed capacity, the utilization levels? So from our understanding is that you budgeted a capital expenditure of about 110 crores in FY25. Can you tell us how this actually pans out for your overall capacity as well?
Our capacity, total production capacity is 24,200 metric tons per year. And our capacity utilization this year has been low, about 50%. But the coming year, it will increase to about 70 to 75%. And we have also adding new products. So that will augment the capacity by realigning our plant capacities for better product mix.
So where does this 110 crores of capital expenditure go towards? What areas?
Sir, in this, we are adding one intermediate complex in our existing plant at Sandila, and 60 crores we are spending in our subsidiary, 100% subsidiary by name Shalvi Specialties, which is coming up at Hamirpur. So we would be doing a capex this year of 60 crores, and we have planned a capex of about 400 crores in the coming 3 to 4 years at Hamirpur site.
And so you've also commissioned an intermediate plant towards backward integration. Now, this backward integration is towards fungicides primarily, am I correct? So what are your plans in this particular area?
Yeah, no, it has been our endeavor to reduce our dependency on Chinese imports. So we normally do all backward integration of our products, and it is a step in that direction. Last year also we did for one of the major products, for a major herbicide, we did the backward integration and we started producing the intermediate in India. And this year we have added one more molecule in that direction for fungicide. And this intermediate normally has been imported in India. So we have started making this intermediate now in our plant.
All right.
It will reduce dependency on China.
Right. So, and final question from my end, sir, can you give us an outlook based on your revenues for the FY25 going in? This is, of course, assuming that the monsoons are normal or slightly above normal, then demand picks up. What's the way forward as far as your revenues are concerned and your operating margins?
Revenues, sir, we are expecting revenues of increase of about 20-25% this year. And we expect to have the similar range in the coming years also. And profit, of course, as I told, is difficult to tell exactly as on today. But we feel that 17 to 20% EBITDA margins, we should be able to achieve comfortably.
Okay. All right, Mr. Jain, we leave it at that. Thank you so much for joining us and talking to us here on NDTV Profit.
Thank you.
That's the management of India Pesticides telling us about all that is on the anvil for the upcoming financial year. Well, time for a short break. And on the other side, we have an exclusive interview lined up for you with Ivana Bartoletti of Wipro. And we will also be speaking to Sri Renuka Sugars. Stay tuned in. Back in just a bit.
All right, sugar stocks have been in focus for the last couple of days, ever since Union Minister Hardeep Puri reiterated that we will be achieving the target of 20% ethanol blending by 2025. Remember, this target is something that the government has been talking about for a while, but we are nearly at 2025, and the reiteration has definitely helped the entire pack. Sri Renuka is up 3.5%, but I would reckon that the entire sugar pack is also having another pretty good day. Now, giving us a sector overview today is Atul Chaturvedi, the Executive Chairman at Sri Renuka Sugars. I'm told, Mr. Chaturvedi, that you don't want to talk much about your company, but rather what this policy move will entail. So we'll try and stick to that. But thank you for speaking with us. So let's begin with that key point that the minister said, that Mr. Hardeep Puri said, that we will be sticking to the 20% target of ethanol blending by 2025. So let me begin by asking you whether you think it's achievable.
So first and foremost, I'd like to congratulate the government and the minister for reiterating something we thought was now on the back burner as far as the government is concerned. Because in December of last year, with elections looming ahead, they had banned the ethanol from cane juice as well as B heavy. But the minister's reiteration that they are on target gives us confidence. It's like a whiff of fresh air. So whatever headwinds the industry was facing by way of ethanol not getting made from cane juice and B heavy, now I think possibly that will be a thing of the past. So we welcome this decision. But as far as whether we will be achieving this during the current year or next year, that's $1 million question. What we are seeing as of this year, the government requires something like 825 crore liters of ethanol for achieving 15% blending. Against that, till May of 31st, the figures we have, about 327 crore liters has been supplied, of which about 165 crore liters has come from the sugar sector and another 162 crore liters from the grain sector. So this year, their achievement till now is closer to about 12.5%, but I see no reason why they should not be able to achieve 15% in the balanced period of the year. Next year, if we do not have policy flip-flops like we had this year, then I'm sure we are on track to achieve 20% blending as per the Prime Minister's wish of achieving 20% by 2025.
Sure. Mr. Chaturvedi, if you could come in on the sugar production for the sugar year in the upcoming year, and what we have in terms of estimates is a potential decline in production. And that's the anticipation. Based on that, your view on how sugar prices could move, to what extent can we expect hikes considering the demand and supply situation? And secondly, what could that mean when for exports of sugar from India?
So first thing first, I'm not a brave man to start predicting next year's crop. In fact, we tried being brave last year and look what happened. The government panicked and they ended up banning exports. They ended up banning cane juice from into ethanol and B heavy into ethanol, just to ensure that the sugar prices remain in check. This year, we would much rather not speculate or rather punt on what the crop's going to be. But having said that, let me just share with you that the monsoon this year has been absolutely on track. And we had very good pre-monsoon showers, maybe a little bit of a loss in acreage may have been experienced in Maharashtra, but that I'm sure is going to get compensated by higher yields and higher recoveries. So overall, I don't see the sugar crop numbers coming down next year, contrary to what some of the punters may actually be saying. And international punters are also probably saying something on those lines. So I won't bet on that. Now, whether the exports will happen or not happen, that's $1 million question. As of today, according to the numbers we penciled in, India would end up having something like 8.6 million tons of sugar at the end of this sugar season, which is about something like 3 million tons higher than the opening stock. So it doesn't make much sense to keep carrying sugar and build on inventory and increase your interest cost. So we would expect the government should at least release 1 million or 1.5 million for exports. So that should reduce the inventory levels. And we don't need to worry too much about the sugar prices because our industry is highly regulated. So I don't see any reason. But if push comes to shove, our first thrust should be on increasing ethanol and then on sugar exports. As it is, the sugar export values have come down and it is not as lucrative as it was about 3 to 4 months back. Yep.
Right. So a twofold question here, sir. Firstly, do you have any expectations when it comes to restrictions on juice and B-heavy molasses for the next season? Do you think that there could be a relaxation here? And also, sir, a word on your expectation when it comes to FRP going ahead.
Reason why this ban on cane juice and B-heavy should not go away. There is absolutely no reason, because we do not see sugar stocks inventories coming down and having an impact on the prices. And let me just reiterate that sugar in our country is absolutely inflation proof. If you really look at it, sugar and edible oils in our country have probably seen negative inflation. The inflation as far as our country is concerned is largely pulses and vegetables. So that is what is actually driving inflation, not sugar, not edible oils. So we would feel that the government also is aware of all these numbers, because these are all government numbers. So there's no reason why this ban should not get lifted. And secondly, as far as next year FRP is concerned, that has already been announced. But having said this, it's also important that the government actually raises the price at which ethanol is sourced by the oil marketing companies. In fact, it's an anomalous situation where ethanol made from maize is currently being sourced at closer to about 72 rupees a litre, and ethanol from B-heavy at 60, and from cane juice at 65. So I think the government needs to seriously look at jacking up the ethanol prices and bringing it at par with maize. And as far as this MSP is concerned, I think it's high time that MSP got raised, because the last 5 years, FRPs or the cane prices have been jacked up, and next year again is going to be jacked up. And there's been no increase in the minimum selling price. So I think it's important from the industry's perspective that this is institutionalized. So if FRP goes up, the issue price should also go up.
Okay, whether you can bring up prices then or not remains to be seen, since that's, we'll get to that bridge when we cross it, since you're expecting that to happen around Diwali or so. But thank you, Mr. Chaturvedi, for speaking with us today. That was the management of Sri Renuka Sugar, giving us an industry view, actually, more than anything else. Now, before we end the show today, I just wanted to play out a bit of a very interesting conversation I had the opportunity to have. We know that artificial intelligence is the buzzword. Everyone's talking about it. But Agam, the reason that I was keen on this conversation with Ivana Bartoletti, she's a global renowned expert on policy of AI, is now with Wipro as their chief policy head for artificial intelligence, and all IT companies are making big moves there. I talked to her about what the key challenges were, because things like data privacy, how you use AI, and the business case still have to be worked out. So before we get into that break, let me just play a slice of that conversation for you.
At the moment, people will think AI is going to destroy humanity, and people will think that artificial intelligence is going to make us so much better. So responsible AI, to me, means that we are going to define the relationship between humanity and artificial intelligence, and ensure that AI is going to benefit the world by harnessing artificial intelligence as much as we can. But to do so, we have to do it in a way that enhances the values that bring us people together, that enhances dignity, that enhances the way that we deal with the issues of tomorrow, that protects the environment. So to me, responsible AI really means that we, yes, harness the value of AI, but we do it in a way that really protects the world and really builds on the values that bring us together.
Now, having said that, What about this in the Indian context? You're currently, framing that policy for Wipro, a company that is moving very, very quickly on upgrading its AI presence and exposure, as is the entire suite of companies here in India. I mean, India is really trying to rev up and sort of level up on the AI game. So in the Indian context, how do you see it? Because we're still in the process of finding a framework that works for us. Is this going to be something that a country determines, or is this going to have to be a global effort?
So artificial intelligence does not exist in isolation, right? So already existing legislation do apply to artificial intelligence. So for example, privacy law, privacy and data protection, they already apply to AI. So AI is not neutral in that sense. So it's really important to understand the legislation such as privacy, data protection, the cybersecurity requirements, as well as legislation like human rights and non-discrimination. All of these apply to artificial intelligence. And this is important because a lot of people are here, they keep invoking for new AI regulation. Now, why is this really important to regulate the behavior of people around and businesses around artificial intelligence? It's also very important to recognize that AI already exists in a world which is regulated. So, for example, India's recent privacy and data protection bill or applies to artificial intelligence systems when these systems use personally identifiable information. And this is really important because one of the crucial things and risks that we talk about when we talk about AI is really around privacy, is really around data protection. So it's important to understand, I think, that whilst we do need to understand whether existing legislation is fit for the age of AI, we also need to bear in mind that there are existing laws that already apply. There are so many conversations around AI governance at the moment. Just a few weeks ago, there has been a summit in South Korea where leaders from all over the world have gathered together to really look at what governance looks like, what it means to monitor the development of deep fakes, what it means to look at cyber threats, and what it means also to get together behind a set of principles that companies can get behind and countries can get behind. Now, artificial intelligence does not stop at borders, so the international dimensions is very, very important. And countries and different jurisdictions will also set the rules. The European Union, for example, has recently enacted the European AI Act, which is a risk-based legislation, and wraps controls around artificial intelligence systems based on the risk that they pose to health and safety, as well to fundamental rights. So there is a big discussion happening everywhere around the world around governance that is both global and has to happen within the AI strategy that have been developed within countries. Certainly, India is.
So let me take that forward. In the Indian context, there are a couple of sort of conversation points. Do you keep this light touch? Do you have stringent guardrails? Also, there is a unique perspective to look at, right? We are going to be or are already some of the largest data generators of the world because it's a large population. You also have the risks of inequalities increasing because of AI. Access, not being fair because of AI. Do you think all of those things also need to be kept in mind? Because we'll wait now for what the Indian version of AI policy looks like. Will these be key touchstones?
Yeah, I mean, this is a great question. And obviously, we will see with the political development in India, the sort of new political setup, how the debate will evolve. And I think it's correct. There are different ways of looking at things, but I don't think that every country will do it in the same way, in the sense that I think it's important to understand that there is a global conversation around artificial intelligence. For example, in South Korea and before in Bletchley Park, India was there alongside many other countries. So there is a global conversation. And I think there is now an understanding that in order to harness the value of artificial intelligence, we need to look at exactly the issues that you mentioned. So, for example, the issue of fairness in artificial intelligence systems, not just in terms of access to the systems, and access to the digital realm, which obviously act as an equalizer of opportunities, but also the inherent bias that can happen within the systems. Issues around cybersecurity. I think there is an alignment all around the world that there are a set of risks that need to be managed. Whether this happens through regulation, whether this happens through business self-regulation, or whether this happens through standards, there are many different ways of doing this. But I do think that there is some alignment around the world on recognizes what the risks are. Certainly, India is in a unique position. It's a huge country that generates a lot of data, and also a country that makes and can make a huge opportunity in, for example, and a huge presence in the discussions at global level around AI for the common good, what it means to shape an ethical AI, and what it means to use and leverage artificial intelligence to solve some of the biggest issues that we have these days. So I think it will be interesting to see what happens next, but there is no one way of govern AI. There is no one way. The European AI Act, for example, is the first AI-specific legislation, and the jury's out there to see what is the best way to govern artificial intelligence moving forward.